You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. This is Brian Overby with Ally Invest and the author of the Options Playbook. Well, today we're going to take a look back. We're going to go back in time and look at a trade that we did on paper that happened to work out for the best. We're going to go back and look at a Boeing long straddle. And we're going to cover this episode was episode number 264, done about 13, 14 days ago, a couple of weeks ago. And we were just talking about the fact that implied volatility came in on Boeing. We weren't quite getting to earnings yet, but there still was a lot of news out on the underlying stock. On that day, Boeing was actually down $5, but a $5 move on a $340 stock at that time isn't a huge percentage move, but overall the stock was just really volatile over the last 4 or 5 months because it's been news-driven. So we don't know where it's going to go to next. Is the next bit of news going to drive it down, or is it going to drive it up? We don't have earnings around, so we went out and bought a long straddle, bought the 340 call, 340 put, and this was on June 12th. And we went out until the mid-July month, and basically we paid $22 for that straddle, and right now, today, we're taping Options Playbook Radio, and it is June 26th. It is a Wednesday. It's a couple of weeks after we taped that program, and we see that Boeing now went from 340 to today it closed, and I'm just going to round up to 375. It was up about the same $5 that it was down the day that we taped the show. So it went up well over 40 points. The long straddle right now is trading for 38.22. So the 340 put that we bought is on the ask price 129, and the 340 call that we bought on the ask price is 37.40. So overall, the trade, you'd think hard about getting out right now. It was July 19th expiration. You got a few more days, but you should definitely trade out of the call on one side and try to at least get your money back. Obviously, you're doing very well if you just sell the call, which is at $38. But if you want to let the put ride, you feel free to do it. But I would probably, if anything, sell a put spread, either do a long put spread or even a short put spread if you wanted to, and kind of let that ride out and see where that ends up at. But with that said, well, the concept behind the long straddle is a lot of people look for the long, and I mentioned this on the call a couple of weeks ago, is look for stocks that are going to be announcing earnings, and it's a known event, and the marketplace just really jacks up implied volatility, making it very hard to do long straddles time and time again and actually be profitable. But with Options Playbook Radio, all we're looking at, we really don't have opinions on the stock, no idea if the stock's going to go up, going to go down. The volatility just was there, and the implied volatility came in. So on Options Playbook Radio, all of our paper trades are just meant to be learning situations, and we're trading more on the price. We're looking at what's going on behind the scenes in the pricing of the option contracts and looking for strategies that might apply based off of the pricing. So it's just a totally different way. And a lot of people always say, well, what's your favorite strategy? There is no favorite strategy, and there's no golden book, oh, this one strategy wins time and time again. But we're just going to try to address different conditions when things look decent to attempt this strategy. Okay, so let's rinse and repeat Boeing. That's part of the reason why I'm bringing it up. I'm not bringing it up because the trade did well. It did extremely well, honestly. The stock moving that much from 340 up to 375, so 35 points. Just happened to go up another $5.60 today. And once again, we are taping on June 26th. The markets are closed right now. But we mentioned in the call a couple of weeks ago that Boeing is going to announce earnings. So now I think we're close enough to the earnings report that there's a different type of trade that we would like to do. And I still believe that the underlying stock has some volatility in it and that the premium is cheap relative, even though we're going into earnings. So let's look at a Boeing long calendar spread. The earnings announcement date is going to, at this point in time, it's anticipated to be on the 24th of July. So the first thing that I always do, the easiest way to double check to see if the marketplace believes that it's also on that date, is to look at the expiration after earnings and the expiration just before earnings and see if there's what's called a volatility skew or a volatility tilt. And in our scenario, the closest expiration to the 24th date will be the 26th. So if you look at the July 19th expiration, you're going to see that the implied volatility on the at-the-money option, the most at-the-money, which is 375, is trading at 26.5% implied. And the 30-day, the July 26th expiration, 2 days after the earnings event, is trading at 30%. So we're already got a 4% skew. Kind of makes us think that the marketplace is believing that that earnings is going to be before the July 26th date. So let's go and look at a long calendar spread. Now, you can skew this any way that you want. You could go to the downside and you can do a long calendar with puts and go out of the money on the puts, or you can skew it to the upside and say it's 375 now. Maybe I want to look at the 380 or the 377.50 and skew it with calls. I'm just going to do an at the money at this moment. Mainly because we don't really pick directions here, and it's more, once again, about the strategy. The fact that we got a $375 stock adds a little bit of premium to the option contracts. The implied volatility is obviously increasing, but it's still not extremely high, considering what's going on with earnings being announced, and also just with the stock and how news-driven it has been. So we're going to look at buying the 375 call on July 26th, which is 30 days out, and we're going to sell the 16-day July 12th call, and that creates a long calendar spread, otherwise known as a horizontal spread. And the way that I'm going to approach this is we're kind of hoping that Boeing just settles down. We got a big move up on the stock. We hope that it just kind of hangs in this range. And then maybe we can go into earnings being long a call for a much lower price than just buying the call outright. And when you think about long calendars, you are positive increase in implied volatility. And sometimes that's counterintuitive, but you want implied volatility to increase on the option that you're buying and decrease on the option that you're selling. The main concept behind a calendar is that when you do a calendar, the front month decays at a faster rate than the back month, and that's the main reason why we like to buy long calendars, is because this is a known fact about option pricing. But we can also take the volatility component out. A lot of times, the front month options, if volatility is slowing down, will decay at, or will decrease in implied volatility, or at least stay flat, where that month that has that expiration, as that earnings announcement approaches, has a tendency to increase. And I still think, so we're making basically a forecast on implied volatility as much as we are on the underlying stock. So in this instance, let's get to the actual trade. Okay, we're looking to do a long calendar spread in Boeing. We had some success with the long straddle. We're going to stay with the long, we're going to stay with the same underlying, and we're going to go out and sell the July 12th expiration $375 call, and at the same time buy the July 26th expiration $375 strike call. The long expiration, the one that has earnings, is trading at the midpoint for $13.30. The one that we're selling is trading at the midpoint for $8.55. So we have some expensive options overall. But the long calendar spread is $4.75 at the midpoint, if we could fill it at that midpoint. The ask is $505, the bid is $445. So they're decent markets on these option contracts, decent volume, decent open interest. Boeing's been in the news. So the midpoint we're talking about is $475. That means for every 1-by-1 long calendar spread that we're looking to do, it's going to cost us $475 plus commission to put that trade on, all the way up to that first expiration date. That's the maximum that we can lose. We hope that implied volatility stay flat or go down in the front month and increase in the back month. So the only time I really like to do long calendars is the exact opposite of the long straddle. We talked in the call 2 weeks ago and said, I do not like to do a long straddle when it's a known news event. I would prefer to actually do something like a long calendar, something where you are trying to manipulate the implied volatility in your favor. One of the biggest components, one of the hardest components to deal with when you're trading options is what's going to happen to implied volatility over the life of the option contract. And this is the one time where you can say, well, the one that I'm buying, I'm pretty sure it's going to increase in implied volatility. And the one that I'm selling, well, I'm pretty sure it's going to stay flat or decrease. And we definitely know that time decay is going to work in our side, without a doubt. So now we just got to hope that we're kind of right about the direction. And the ideal scenario is that Boeing just hangs around 375 here for the next 16 days until that July 12th expiration. We got the 4th of July. People are starting to get bored with the markets. They're enjoying their summer. So let's hope we get a little bit of the doldrums, and we end up long the 375 call. Ideally, the front month would go away with the stock still hanging around 375, and we can ride that call into earnings at a much lower price. Now, if you just want to get out of the trade, you got to remember that a long calendar spread isn't something you're going to hit a home run on, or you're not going to look to put it on for $475 and then sell it for $9, basically doubling your money. That's not the concept of them. If you're going to trade them just for time decay and try to get out before that first expiration date, you might go a week from now and then maybe you're up 50 cents or even 75 and you sell it and you get out. Still a decent rate of return. It's just a different approach. So I like long calendars, and specifically in a little bit more expensive stock, like Boeing, a $375 stock, that adds some premium to this underlying option contracts overall. And since we had some success in the long straddle, we're just going to roll. And I think it's very important just to say that, yeah, I'm not going to keep doing long straddles. We called one right, and it's hard to get them right. So we're not going to look a gift horse in the mouth. And now I think the long calendar call spread or put spread, if you want to be a little bearish and lean a little bit to the downside, is a better strategy to use in Boeing since it's had its big move up. Well, that's it for this episode of Options Playbook Radio. If you have any questions you'd like to answer, like us to address on the show, please email me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.